Right now, Bitfarms, ticker BITF, is trading at $3.81, and it's having a rough start to the day, down a sharp 6.40% in the opening hour of trading. Now, the easy assumption, the one most people watching this stock will make, is that this is just another Bitcoin miner getting dragged down by the crypto market. After all, Bitcoin itself is looking shaky, struggling to hold that $100,000 level and breaking below key moving averages. The logic is simple. Bitcoin drops, miners like Bitfarms drop. That's the expectation. But the reality of what's happening with Bitfarms today is far more complicated and, frankly, far more interesting than just a simple proxy trade. The real story here isn't just about the price of Bitcoin, it's about a company in the middle of a high-stakes identity crisis, and the market is getting extremely nervous ahead of its earnings report, which is scheduled for November 13th. Today's heavy volume, already hitting nearly 50 million shares so early in the session, isn't just panic selling on crypto weakness. It's institutional reevaluation. It's the market trying to price in a massive $500 million convertible note offering from last month and a wave of deeply pessimistic analyst estimates that have come out just days before the company has to show its books. Let's be clear. Everyone knows Bitfarms as a Bitcoin miner. It's one of the older names in the space. The general belief is that you buy this stock for leverage to the price of Bitcoin. You check the Bitcoin price on your Robinhood app, see it's up, and you assume BITF should be up more. You see Nvidia stock ripping because of AI, and you think of crypto mining as a totally separate, less sophisticated cousin. For years, that's been the trade. But that entire model was fractured by the Bitcoin halving event back in April 2024. The built-in reward for mining was cut in half overnight. Suddenly, the business model of just plugging in machines and collecting coins became a race to the bottom, a desperate fight for efficiency, where only the operators with the absolute cheapest power could survive. This is the new reality. And this is where the story gets a sharp, unexpected turn. The Bitfarms you think you're trading today is not the Bitfarms the company is trying to become. The management team saw this writing on the wall. They understood that being a one-trick crypto pony is a death sentence. So what did they do? They started a massive, complex, and costly pivot. Earlier this year, they made two huge moves. First, they completed the acquisition of Stronghold Digital Mining. Second, they strategically sold off their 200-megawatt data center in Iguazu, Paraguay. This wasn't just housekeeping. This was a radical portfolio rebalance. They dumped a major South American asset to double down on the United States, specifically in Pennsylvania. Why? Not just for Bitcoin. They did it to get access to high-quality U.S. power grids and infrastructure that are suitable for something else entirely: high-performance computing, or HPC, and artificial intelligence. They've been hiring executives with AI and infrastructure backgrounds, signaling a clear shift in strategy. They are trying to reposition their data centers as dual-purpose facilities that can mine Bitcoin when it's profitable, and pivot to service the power-hungry AI industry when that's the better play. This is the tension at the heart of the stock. The expectation is a simple miner. The reality is a complex infrastructure company attempting a gut-wrenching transformation. And the market is terrified. Why? Because transformations are expensive and risky. That $500 million in convertible senior notes they just raised in October? That's the war chest for this pivot. But it also represents potential future dilution for current shareholders. And as we head into the Q3 earnings call next week, the consensus is grim. Analysts aren't focused on the Bitcoin in their treasury. They're focused on the cost of this pivot. The consensus estimate is for a loss of 2 cents per share. More importantly, those estimates have been revised downward by 50% in the last 30 days. That is a flashing red signal of analyst pessimism. The stock has a Zacks rank of number 4, which is a sell, and a negative earnings ESP of -100%, suggesting a high probability of an earnings miss. Some major one-year analyst price targets are sitting around $2.57, which, you'll note, is significantly below where the stock is trading, even after today's haircut. So today's 6.4% drop is the market bracing for impact. It's a collision between the old narrative and this new uncertain reality. Traders on platforms like Interactive Brokers, who look at deep financial data, are weighing the company's 85% year-over-year revenue growth against its negative earnings outlook and massive new debt. A beginner on SoFi Invest might just see a cheap crypto stock and try to buy the dip, but the professionals are looking at the cash burn, the capital expenditure required for this HPC pivot, and the intense competition from other miners like IRN or Hut 8, who are trying to do the exact same thing. It's a race to see who can repurpose their infrastructure fastest. Even if you're a long-term bull using Schwab Intelligent Portfolios for diversification, a stock this volatile and this speculative is a difficult holding. It's not a set-it-and-forget-it investment. It's a high-stakes bet on a corporate turnaround. What does the company actually do? It's an infrastructure business. Bitfarms builds, owns, and operates large-scale data centers. Historically, these centers were filled with specialized computers, ASICs, that do one thing: run calculations to validate transactions on the Bitcoin blockchain, a process known as mining. For doing this, they are rewarded with new Bitcoin. Their entire business model depends on two variables: the price of the Bitcoin they earn and the cost of the electricity they consume. When Bitcoin prices are high and power is cheap, they print cash. When Bitcoin prices fall or power costs rise, their margins collapse. Their operations are spread across Canada, the United States, and Argentina. The recent acquisition of Stronghold gave them 3 key sites in Pennsylvania, which is part of the PJM interconnection, one of the largest and most liquid wholesale electricity markets in the U.S. This gives them flexibility in managing power costs, which is crucial. But again, the future they are selling to investors is not just mining. It's using these high-energy facilities to power AI models, which is much steadier, contract-based business, unlike the wild volatility of crypto. Looking ahead, the future for Bitfarms is a fork in the road, and next week's earnings call will be the signpost. There are 2 primary scenarios. In the first, the bullish scenario, management comes out and provides a crystal-clear roadmap for the HPC and AI transition. They need to show that the cash burn is under control, that the Stronghold integration is going smoothly, and that they are genuinely close to signing high-value contracts for HPC services. If they can convince the market that the dilution from the $500 million offering is an investment in a more stable, higher-margin future, the stock could find a bottom. In this view, you're not buying a miner, you're buying a data center and energy infrastructure play at a discount, a bit like trying to buy Nvidia stock or Apple stock in their early misunderstood days. But the bearish scenario is far more immediate, and according to analysts, more likely. In this scenario, the earnings report confirms the high costs. Management is vague on the HPC timeline. They show a declining Bitcoin treasury because they had to sell more coins to fund operations. The market will see this as a failing miner desperately trying to pivot, but getting crushed by debt, high energy costs, and the post-halving reality. The stock could easily break below its recent support and head toward those bearish analyst targets in the $2 range. If you're trying to manage this risk in your individual brokerage account, whether at Fidelity or using the Fidelity mobile app, the volatility here is extreme. This isn't a stock for a standard Fidelity IRA. It's a speculative instrument. I want you to comment below. Do you believe Bitfarms can successfully transition into an HPC and AI company, or is this a failing miner grasping at straws? In the end, we're left with this powerful disconnect. The expectation is that Bitfarms is a simple Bitcoin mining stock, a leveraged bet on a digital commodity. That's the story that got it to its 52-week high of $6.60. The reality is that Bitfarms is a company in a painful, expensive, and public metamorphosis. It's shedding its old skin and betting the entire farm, pun intended, on a future in AI infrastructure. Today's sell-off shows that the market has lost faith in the old story, but isn't yet convinced it can buy into the new one. The company is trapped between 2 narratives, and until it can prove its new identity is more than just a press release, investors are pricing it for failure, not for success. I can dig deeper into their specifics of their $500 million convertible note offering and its potential dilution impact.